Welcome to the FT's Global Commodities Summit. This afternoon I'm joined by Dunand, the Chief Executive of Mercuria. Marco, welcome.
Thank you.
Now, congratulations. You've just pulled off one of the biggest deals in the trading industry in recent times, 3.5 billion acquisition of JP Morgan's physical commodities business. Can you explain to us and our readers a bit about the deal, why it is you want to do it, the opportunities you see there, and how that meshes with the business that you've built in the last 10 years?
Absolutely. We looked at that deal for several months, and we realized actually that the activities of JP Morgan Commodity were very complementary to the one we have. They have some businesses in the US, which is in gas and power physical activities. They have a big office in Calgary, trading both gas and crude. Very active in base metal in Europe, structured sort of deal across the globe. Essentially, all activity that we've been wanting to get into, but that we were going to go into a gradual sort of move. And we can actually do this in one transaction with a team, which is a pretty solid team, which has been around for a long time. One of the aspects of a takeover, which is probably more of a merger in a sense of size.
A merger rather than a takeover.
They're pretty similar in size, so it's a takeover obviously from a contractual perspective, yes, but it's actually pretty much of a merger. And obviously, when you merge two companies, the cultural aspect to it is extremely important. And you have the banking culture and the trading culture. But we feel that in this particular case, for a start, JP Morgan has been strongly influenced by the Sempro culture, because they acquired that business from RBS a couple of years ago. So we've known those people very well.
A business, yes, you know well.
And we know well, because obviously I used to be there. Yeah. And I worked myself in the banking industry for over 15 years, so I think I understand the banking culture reasonably well. So we think that, well, there is a gap. Hopefully that gap is actually not so wide, and we'll be able to sort of merge the two companies, and it might take us 6 to 12 months, and hopefully we'll have an ongoing structure and platform, which is going to be the one we wanted to have, which is ability across the globe to trade physical, paper, and service some counterparties.
Okay. And just another sort of question related to the deal. We're obviously seeing a big change in the US energy market because of the shale revolution in both oil and gas. How do you see that impacting sort of energy flows in the US and the opportunities that, say, this platform now gives you to exploit those?
Well, the US is benefiting from a huge competitive advantage from the price of energy they pay, mostly through the gas sort of prices, which have been fluctuating between 4 and 5 per BTU, compared to 3 times higher in Europe. Obviously, there's limited ability to export gas from the US. It will come over time, but if you see actually, because of the differences in market price, other products have been, the US have been exporting a large amount of coal, but also been exporting a large amount of refined product of butane, propane. So there's a lot of side products which are being exported, which obviously we're trying to position ourselves into that segment. And JP Morgan does have some activity which are very complementary to us into trying to kind of use the new shale prices revolution and try to essentially export this kind of cheap energy in some different form than gas into other part of the world. Yes.
Yeah. Okay, and can we just ask just a bit about investment banks? I mean, you've worked there, Goldman previously. What impact is their retreat having on the market? Are we seeing lower liquidity towards the back end of the curve, for example, at the moment?
Yeah, I think that the investment bank traditionally were not that much involved in physical activities, so that there's very little impact on that, and actually the competition is very strong when it's sort of about moving commodities around. But
on the financial side?
But this is on the physical side. On the financial side, it's a very different story. If you look at the back end of the curve, the liquidity has dried up substantially, not completely, and the bid offer has sort of widened. So I suppose the risk you're taking on because of the lack of liquidity, hopefully you should make back with the bid offer, which is why essentially people are now asking for a bigger discount or a higher premium to warehouse risk compared to what it was a couple of years ago.
Okay, and is that partly an unintended consequence of the regulation that we've seen come into?
I think a lot of people have spoken about regulation. I think maybe one of the main reasons behind the bank exiting has just been that the profitability of their commodity sector hasn't been that high. You know, there have been discussion today about the fact that if you were taking the top 5 or 6 sort of investment bank in commodity, you know, 5 years ago, their revenue were between 10 and 20 billion. Those revenue have shrunk to 5 billion maybe in the last year. So I think that while regulation obviously are one of the factors, the profitability or the lack of profitability in the sector, which essentially is due to the fact that commodity prices have been a lot more stable over the last 3 years than they've been prior to that, has meant that the opportunity for those banks to make money has been reduced. And I think that's also prompting some of the exit.
Well, Marco, thank you. That was very interesting.
All right. Thank you very much.